The collapse of the second-largest bank in U.S. history serves as an example of an ongoing trend. More banks are now facing serious challenges. This collapse, which is the second biggest in U.S. history, raises concerns about the stability of other financial institutions. Another bank failure highlights the ongoing issues. In fact, earlier this year, 3 major banks collapsed, indicating a possible chain reaction of failures in the banking sector. This situation is particularly troubling for regional banks, as their future is at stake. The collapse of banks such as Silicon Valley Bank, Signature Bank, Credit Suisse, and First Republic is a clear signal of a troubling trend in a sector grappling with rising interest rates, bad loans, lower deposit rates, and declining profits. Welcome back to Learn Geo, where we bring latest news about the world affairs, technology, world economy, and lots more. Now let's dive into today's topic. In 2023, numerous financial institutions are exposed to risky assets. This fact might not be apparent to account holders until a major crisis occurs, and their ability to withdraw funds becomes compromised. The vulnerability of regional banks is amplified by the Federal Reserve's aggressive interest rate hikes, which have eroded the value of their assets, including government bonds and mortgage-backed securities. While most bonds become attractive when interest rates drop, leading to increased demand and higher bond prices, the opposite occurs when interest rates rise. This dynamic explains why some institutions have experienced significant drops in their market capitalization, even surpassing 80% this year. Among the banks currently under scrutiny, Ally Financial stands out. Operating as a digital bank and serving as a major auto lender primarily for General Motors and Stellantis auto dealers, Ally Financial faces a dual challenge in 2023. Its balance sheet shares similar risks with other struggling banks while also being excessively exposed to the negative effects of higher interest rates. This exposure includes the potential for a surge in auto loan delinquencies and reduced demand for loans. The company's situation is worsened by an increase in deposits at a time when interest payments are also rising. In essence, Ally Financial is grappling with multiple adverse factors that could further impact its stability. The nearly $29 billion invested is generating lower returns than the current rate offered to depositors. Additionally, there's a slowdown in its auto lending business with growing credit risk as more loans become problematic. Currently, delinquencies account for 1.9% of total auto loan originations, marking a 70 basis point increase year over year. The rise in delinquency rates among loans originated within the last 12 months is concerning, indicating that consumers' true credit quality might not be as positive as Ally Financial believes. Given these factors, it's anticipated that the worst is yet to come for Ally Financial. This situation will be closely monitored, and potential investors are advised to conduct thorough due diligence before considering an investment. Moving on, based in Dallas is one of the banks that credit ratings firm Moody's recently placed under watch for a possible downgrade. Cracks are becoming evident in C's system. Analysts point to factors like a significant amount of unrealized securities, lower capitalization compared to last year, and a larger portion of deposits exceeding FDIC insurance thresholds. These factors place the bank at risk of facing failures and potential liquidity constraints. Megan Fox, a senior analyst at Moody's, notes that these circumstances could make C more vulnerable to rapid and substantial withdrawals by depositors, potentially requiring asset sales. The erosion of its deposit base, reliance on market funding, crystallization losses, and risks to profitability and capitalization all contribute to the threat to the institution's safety and its depositors' assets. Shifting to KeyCorp, an institution based in Cleveland, Ohio. It operates KeyBank, providing retail and commercial banking services, student loan refinancing, and mortgage services. Only a small percentage of my viewers subscribe to my channel, so please consider subscribing to Learn Geo and giving this video a thumbs up. Don't forget to click the notification bell to receive updates on our latest content. Now let's continue. The delinquency rates at KeyBank are currently heading in an unfavorable direction. Data from Seeking Alpha reveals that all categories of loan delinquencies have increased at KeyBank, resulting in lower profits. This has contributed to the stock's diminished appeal for potential investors. Unexpectedly, the decline in quarterly profit was substantial at 50%, and credit loss provisions surged by 271% to reach $167 million for the quarter, compared to $45 million in the same quarter a year ago. The company's latest report also brought to light that its net interest income experienced a significant drop of nearly 11%, totaling $986 million for the quarter ending on June 30th. This was in contrast to $1.1 billion from the previous year. Furthermore, net income from ongoing operations attributed to common shareholders was reported at $250 million, or 27 cents per share, as opposed to $54 million or 54 cents per share from the previous year. These factors collectively have prompted investors to start offloading the stock, leading to a substantial 44% decline over the past year. Adding complexity to the situation, KeyBank is anticipating that loan losses will continue to rise alongside increasing borrowing costs. This necessitates the company's preparation for an influx of defaults by early 2024. In simpler terms, KeyBank is currently experiencing significant financial strain, and if the projected outcomes materialize, the situation could rapidly deteriorate from bad to worse. Truist Financial Corporation, based in Charlotte, North Carolina, is another superregional bank. Facing significant challenges, it's poised to encounter liquidity problems and heightened exposure to financial losses in the forthcoming quarter. In the first half of 2023, the bank's shares underwent a 30% drop, as reported by data compiled by S&P Global Market Intelligence. By the end of the first quarter, Truist held unrealized bond losses amounting to nearly $20 billion. CEO Bill Rogers acknowledged a drop of around 2% in deposits for the quarter, which can be attributed to quantitative tightening, a process where the Federal Reserve reduces its balance sheet, subsequently leading to the withdrawal of deposits from the system. Rogers admitted that this deposit pressure is likely to impact revenue on a quarter-to-quarter basis. In terms of financial performance, Truist experienced a 2.8% decline in net interest income and an 8 basis point drop in net interest margin. The declining profits could potentially compromise the company's ability to withstand a low double-digit increase in delinquencies or a sudden surge in outflow rates. These two factors were the main drivers behind the Silicon Valley Bank crisis. One of the banks facing these challenges is Pacific Premier Bancorp, a full-service commercial bank headquartered in Irvine, California, with branches across California, Nevada, and Arizona. The bank has a rich history dating back to the early 1980s when it was initially established as a small community bank. Over time, it grew to possess assets worth $21 billion with a capitalization of $2.17 billion. However, following the collapse of Silicon Valley Bank, Pacific Premier Bank's expenses have surged along with the potential for credit losses in 2023. Although the bank reported a provision expense of $2.8 million in 2022, this year has seen expenses soar to over 5 times that amount at $14.00 million. Notably, deteriorating asset quality and unfunded commitments within the loan portfolio are affecting credit loss provisions for the third quarter. While the banking sector is bracing for the impact of rising delinquencies, Pacific Premier Bank appears inadequately prepared to handle potential profit losses, placing it at risk of becoming the next casualty. Another bank facing challenges is Sandy Spring Bancorp, a small-cap bank with a market capitalization of $1.47 billion. Economic activity significantly affects the bank's profit and value due to the nature of its operations. The bank is exposed to risky assets through lending to borrowers who may struggle to repay their loans. Typically, bad loans that cannot be recovered should constitute less than 3% of total loans. However, Sandy Spring's rate of bad loans at 5.6% in July is nearly twice the norm. Additionally, the bank's exposure to bad loans in the United States, Puerto Rico, and the Virgin Islands has drawn scrutiny from Moody's Analytics, potentially placing it on a watch list for potential failures. Furthermore, government agencies have accused the bank of fraud in relation to the processing and funding of Paycheck Protection Program loans totaling around $1 million. Despite signs of potential fraud being detected, the Federal Reserve criticized Sandy Spring Bancorp's handling of loans, citing ineffective controls, procedural issues, and violations. Currently, Sandy Spring Bancorp is facing financial instability. Throughout the year, the bank has encountered significant challenges, including a substantial downturn and pressure on its financial performance. The bank is grappling with elevated credit costs, securities impairment and valuation losses, all of which are straining its credit ratings. The bank's financial flexibility has also suffered due to a 40% crash in the stock market, a situation worsened by its exclusion from goodwill. As a result, Sandy Spring Bancorp's financial health is deteriorating rapidly, leading to a downgrade in its issuer and senior debt rating to BBB from A. Meanwhile, Eastern Bank, based in Boston, is facing potential difficulties as well. Despite selling some of its bond portfolio to reposition its balance sheet and address interest rate challenges, the bank's shares are at risk of plummeting. The previous year saw a decline in deposits, particularly in low-cost or zero-cost checking accounts. This drop in balances from around $1.5 billion in Q1 2022 to $9.8 billion in Q1 2023, squeezing profits and could potentially lead to a crisis. Similarly, the Bank of Hawaii is contending with challenges to its fee income growth. The bank has experienced a decline in metrics like mortgage banking income, volatility trust and assets management income, and non-interest income. The bank's lack of efforts to diversify and expand its sources of fee income is concerning. As a result, shares of the Bank of Hawaii have fallen by 45.8% over the past 6 months, compared to the industry's decline of 35.5%. In light of industry developments, the situation has grown dire for Silvergate Bank. Its shares have seen significant declines, with PacWest Bank also witnessing a more than 50% fall in shares this month and almost 80% over the year. Moreover, PacWest reported a 99.5% decline in deposits during the last quarter. The weakest link is beginning to appear in the West. Some traders are speculating whether these banks might fail or be put up for sale. In the 13th position is Western Alliance Bancorp, headquartered in Phoenix, Arizona. Presently, the bank is facing significant challenges, while smaller lenders are left to deal with the consequences. This strain has led to a lack of cash on its quarterly balance sheet, a trend that might persist in the upcoming third and fourth quarters. Moving to the 14th spot is Home Street Bank, the holding company for a commercial and mortgage lending institution in the western United States. The bank's recent financial results paint a grim future, missing investor expectations with earnings per share at only 27 cents compared to an anticipated 40 cents. Moreover, a revenue shortfall of around $60 million was observed. With a bank capitalization of $16 billion, Citizens Financial Group is facing heightened exposure to risky assets. Currently, there is an increase in delinquencies and default rates, and the company estimates that 55.83% of its loans are at risk of non-payment due to slowing economic activity. This situation could severely impact the bank's profits in the upcoming quarter as bad loans accumulate. In the second quarter, the bank is already facing financial losses of $310 million. Underlying all of this is the potential for the FDIC's Deposit Insurance Fund to incur losses. While these mentioned institutions represent only a fraction of the over 200 banks facing similar risks to those that caused the downfall of Silicon Valley Bank, their collective vulnerability has the potential to significantly impact the banking sector and the broader economy. Even a few of these banks failing could set off a domino effect, potentially resembling the financial crisis of the 1930s. This underscores the possibility of an impending financial crisis that could arise sooner than anticipated, leaving us ill-equipped to cope with its aftermath. And that's it for this video. Thanks for watching, and see you next time for more interesting videos like this.